In this video, I'm going to be going over market structure. So how to tell if you're in a bullish market, bearish market. I'm also going to be going over break of structure and how to tell what highs and lows are. So to start with the basics, to know if you're in a bullish market, it's basically going to look like something like this. Now, why is this considered bullish trend? Well, because as you can see, it's making highs, making a low, and then it makes a higher high and a higher low. And here as well, makes higher high and higher low. Now, to know if you're in a bearish market, it's going to be the opposite. So it's going to be something like this. Where you have a high, well, a low, a high, and then you make a lower low, a lower high, a lower low, lower high. All right, how do you know when market structure shifted, which means how do you know when it goes from bullish to bearish or bearish to bullish? Well, normally it's going to look something like this, where you're, let's say, in an uptrend, right? Making high, making low, making higher high, making higher low. And then you go from making that higher high to boom, making a lower low. And that's usually when you start downtrending. So obviously your chart's not going to look like this. After this, I am going to go in the chart and show you with the candlesticks, but so you get the idea. Here, as I explained before, you're making high, low, you're making a higher high, you're making a higher low, you make a higher high, and then what happens? Boom, it breaks the past low. It breaks the past higher low. And then what does it do? It creates a lower low. And then what happens? It creates a lower high. All right, to explain it to you guys in the charts, I'll be going in the daily time frame. This is a perfect example. So for the chart to create a high or to create a low, to create a high, it needs to be a green candle. All right, let's say this is a green candle, followed by a red candle. I'm gonna fill in the red candle. Now this is the only way a high can be formed. A high cannot be formed with two green candles next to each other. Why? Because if you think about it, that means if you put it into the line graph, which is honestly easier for this example, I'll do line. The only way a high can be formed is if the next candle is a red candle, because then it peaks, right? If you just have green candle after green candle, then it's a line going like this. But once you have that red candle, that's when it dips and it creates that peak or that high. It's the same for a low. The only way for the market to create a low is if there's a red candle, right? This is a red candle, followed by a green candle. Why? Because when it's going down, right? It's going down, down. If it's just a red candle, red candle, red candle, in a line graph, that's basically just going to look like a straight line down. But once you get that one green candle, that's what creates that spike, right? And that's what you call the low. So a high can only be formed if it's green candle, then red. Low can only be formed if it's red candle, then green. All right, now I'm going to help you guys spot these in the actual chart. So we go to the candlestick chart. Here's a good example. So here I'm in the daily. I'll point out all the higher highs, higher lows, lower highs. So as you can see, here it creates a high. Why? Because it's a green candle followed by a red candle. Here it creates a low. Why? Because it's a red candle followed by a green candle. Then what does it do? It goes up, goes up. There is a red candle here, but it's not that obvious, so I wouldn't count it. I'd count something more obvious, like something like this, where after it forms that, it goes up, goes up, goes up, and boom, what does it do here? Forms the next obvious high. And what does it do here? Forms an obvious low. Now, for this, you would count the wick as the low. So I would put the low here. But for it to actually change in structure, the body needs to close below the previous higher low. And I'll explain that to you guys up here. So what does it do? Keeps going up, 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 higher high. And then what does it do here? Lower high. Now, what is this called? This is bullish trend. And then here, it makes a higher high. But what does it do here? Look, as you can see, goes down, 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 and it makes a lower low, right? Because this low wasn't formed up here. Even though there was a low formed here, like I wouldn't call this an obvious low. The obvious low gets formed below the previous low, and that makes it a lower low. And what do you guys see happens after a lower low gets made? It starts going down. So what does it do? Makes a lower high right here, makes a lower low, makes a lower high, makes a lower low, until what happens? A new high is made. Now, the reason you wouldn't want to trade using this is because, as you could see, even though a new higher high was made, it didn't go up. And that's because this isn't like a strategy, or I'm not telling you use this to make money. This is something you need to know to just have a good understanding of where market wants to go. All right, now I'm gonna explain to you guys why you need to be careful. Because this, you could see this on any time frame. You can see this on the 5 minute, where you see it make high, lower, make a high, a low, higher high, lower low. Now, the reason you need to be careful is because in smaller time frames, these breakup structures that you might see might just be retracements for higher time frames. That's why a good saying is higher time frames hold higher power. And that's true because on higher time frames, what you could think is a breakup structure on the 2 minute, right, might just be a small retracement on the 1 hour or on the 4 hour. Why you normally want to be trading with the trend of the market. Because let's say I'm bullish, right? And I take a long, I'm going to be making a lot more money than I've were a short, and that'd just be a small retracement, right? and then it goes up because at the end of the day, the market's trending bullish. So what I want you guys to do is go to your chart, start off with daily time frame, and just start identifying highs and lows, and then lower lows, lower highs, and higher highs, higher lows. Because the more you practice it, the more you're able to see it without really thinking about it. And then start on the daily and just work your way down on the time frames and see how, like, you're going to be able to see that in a smaller time frame, what you may think is bearish market trend is really just a retracement on the 4 hour, and the 4 hour is just bullish. But the more you practice it, the more you're going to be able to see it like hindsight. And that's going to be all for this video. um, I'm probably going to make the next video about psychology and how that plays into trading. But I'm going to be trying to upload every other day. And yeah, that's pretty much it.